Hey, what's happening? If you clicked on this video, then I know that everything is good. We're still breathing, we're still here, we're still alive. Thank you. Thank you for clicking on this video tonight. I'm Coach UV, and this is the Unique Trading Group, where strategy meets mindset and discipline turns into income. Today, whenever you decided to click on this video, just know that you're in for a good one. It's going to be a little bit different from my other videos. I'm going to be previewing some clips from Mark Douglas, thinking like a professional trader. All right, this is going to be half of part one of a series that I'm going to be doing, all right, called the Douglas Files or the Discipline Files. Want to introduce to the channel psychology mindset. All right, want to take it back to the roots. These are some of the things that I had to learn early on in my journey whenever I was trading. Okay, and whenever I started trading, I was all about making the money, all about rushing into things, and I didn't have a clear plan, and I needed more experience. I needed more to really wrap my head around this thing, and it's really about personal development. Okay, and so I want to show you this tonight. Hope you guys enjoy the presentation. You won't hear my voice or see any charts. It's going to be strictly for those who want to listen to some psychology. Again, this is a guy named Mark Douglas. He wrote a book called The Disciplined Trader and Trading in the Zone. These are the things that helped me in my journey to get to where I'm at now, and where I am to be able to help people and teach them some of these skills. All right, I think that your thinking process is one of the most important things when it comes to trading. Trading can be hard, but it can be easy. All right, skill and experience, right, education and an edge, being able to execute flawlessly, because this is a very competitive game, trading. All right, so I think this is going to help those who want and desire to take trading to a different level, to make this consistent, because the way you thinking like a professional trader changes the game. All right, because when you change the way you think, it ultimately alters your decision making. All right, and so that's what this video is going to be about tonight. And of course, if you're busy, new, a little skeptical about trading stocks, you're exactly who I help. All right, this is the Unique Trading Group. I'm Coach UV. Click that link below and join a thriving community where we teach you how to fish, and check out some of those videos in my YouTube channel in the community, right in the playlist, so you can see proof of concept, proof of me helping other people on this journey. All right, I'm here to help. Again, check out those links below. And if you want to check out a mini course, all right, a free mini course to get you started with some actual live trading on charts, all right, then click that link right above. All right, but what we're going to do is we're going to take a quick commercial break, and then we're going to be right back with the show.
Hello, my name is Mark Douglas, and I'm the author of The Disciplined Trader and Trading in the Zone. I've been a trading coach since 1982, and over the years, I've worked with some of the industry's biggest hedge fund and money managers, as well as some of the exchange's largest floor traders. I know that all of you want to experience consistent results from your trading. In other words, you want to be able to generate an income you can rely on. However, one of the major obstacles in trying to accomplish this objective is in the area of trade execution. To produce a consistent income, a trader has to be able to execute their trades without making any errors or mistakes. In other words, trading without hesitation, reservation, or internal conflict. Basically, all of the errors we are susceptible to are a result of a lack of confidence, or more specifically, trading with fear. What most people don't realize is that trading without fear is actually a learned trading skill, a skill that has to be cultivated, and is the primary difference that separates the professional from the typical trader. In this series of DVDs, I'm going to provide you with the kind of insight, understanding, and specific mental techniques you'll need to learn to trade without fear, so that, like the professional, you can move in and out of your trades with the kind of confidence and ease that will allow you to take full advantage of your wise trade or any other trading methodology. Hello. Yeah, good morning. And also, too, how many people came from the West Coast or in the West Coast time zone? Yeah, it's like the Wise Trade people picked me up at 6:30 in the morning, which was 4:30 in the morning for me. So when I say that, when I say this, we're here for you, and to ignore the cameras, ignore the environment, I really mean that. But at the same time, I want you guys to help me a little bit, okay? It might take me a little bit, to get going, because I'm not used to doing presentations at 6:30 in the morning my time, or 7 o'clock in the morning my time. But anyway, what we're going to do is we're going to go through the process of learning how to think like a professional trader. Why would we want to learn how to think like a professional? Anybody got any ideas? What's that?
Make some money.
Make some money. But you don't have to think like a professional to make money, do you? What does it even imply? What does it imply to think like a professional trader? I mean, let me ask you this. How many you guys have, I don't know what your trading experience has been in terms of the number of years you've been at it, or kind of give me an idea of the demographics here of the audience. I mean, how many people have been trading for more than 2 or 3 years? Most everybody? Then less than 2 years? Kind of new people? Oh, okay, so we've got about half and half. What would it mean to you guys to say, well, let's think like a professional trader?
Maybe not thinking like an amateur.
What's that? Not thinking like an amateur. Okay, that's good. But what are the implications of the difference between a professional and an amateur?
Right, consistency.
Consistency. There you go. You see, you're at my Houston workshop, right? Yeah, consistency. Exactly. In other words, what that would imply is that if I'm a professional trader, in other words, if I've aspired to be a professional, one of the implications would be that I can make consistent money, because if I'm trading in the mode of a professional, I could be a hedge fund manager, a professional hedger working for trading companies, or just having a full-time job as a trader where my income, my sole income, is derived as a trader. And to be in that kind of a position, or to be in a position where other people are going to give you their money or give you their assets to be able to, make money for them, it would certainly imply that you can make consistent money. That there's a way for you to, let's say, create an equity curve that looks, something like this. Isn't that right? Are you going to give your money to somebody with an equity curve that looks like that? I'm not saying that people don't do it, and I'm not saying that it doesn't happen. But I'm saying that if I've aspired to be a professional trader, it means that I must have learned something that's different than the people who can't do this. There must be something about the way that I approach trading that allows me to do that. And believe me, there is. There's a lot. What's that? Yeah, cool. Basically, and I don't know how many people in the room have either read Trading in the Zone or The Disciplined Trader. We've got a few people. So probably there's actually most of the people in the group aren't familiar, maybe even with me or my background at all. True or not? Yes or no? See, no, right? Oh, okay. So I'm going to just give you a little bit, and I'll give you more later on. But I started trading back in 1978, and the first trade that I made, was in potato futures at the Chicago Mercantile Exchange, which they don't even trade potato futures anymore. Why I picked potato futures, I have no idea. I think that's probably what my broker said I should be trading. Maybe he said that there was an opportunity in potato futures, but anyway, I made money. And of course, just like most people who make money, their first trade or their second trade, it's about as easy as one could imagine, and therefore you think to yourself, oh my God, why didn't I learn about this a long time ago? That sounds kind of familiar, right? In terms of a thought process. And I went from trading potatoes to trading gold to trading silver. And I'd say my trading experience back then was probably typical even to what it is today with most people, although you have to keep in mind that the technology that we had back then wasn't anything like what you have available to you right now today. It still boggles my mind when I think about the way we had to trade 25 years ago, or almost 30 years ago, compared to what's available right now. I mean, I've always been attracted more to trading commodities than stocks. As a matter of fact, I've never even traded stocks. I've always traded commodities and options. And I've never really had the desire to trade on the floor, the exchange. Although I lived in Chicago for 20 years, it never really appealed to me. I don't know how many people are familiar with the floor or the trading pits, but I just thought it was an extremely harsh environment, and not something that just, like I said, it appealed to me. But the kind of trading platforms that you guys have available to you today really, truly approximate what it would be like to have a seat at the Chicago Board of Trade or Chicago Mercantile Exchange and to trade at that level. You have instantaneous execution. And it's like you can change your mind and not feel humiliated or like, there's something wrong with you. You can put it in order. You can cancel it. Back, before the advent of electronic trading platforms, we used to have to call a broker. Now you think about the time you made a decision to put on a trade. You think about the time that it takes, one, to dial the phone, for someone to pick the phone up, how many times it has to ring, and then he gets on the other end of the line. You got your broker, and then you give your broker your order, and then you've got to deal with the fact that, does your broker really approve of your order? In other words, what I mean by approve is that, well, see, I want to buy 3 gold contracts, and say, well, some of my biggest customers, they just went short gold. Now what are you going to do with that information? Okay, or I've got X number of guys that are on the other side of that trade. And say, well, yeah, if you want to take the other side of their trade, I mean, that's fine with me. I'll put the order in. So it's like so he could put the order in, and then you've got to wait for a fill. I can't tell you how many times that I put orders in the market where they were limit orders because they didn't want to do a market order because they didn't want to get the slippage of a market order. So you do a limit order, and on a limit order, the market has to trade. To be guaranteed to fill, the market has to trade through your price, does it not? How many times has the market traded to your price, okay, just right to your price on a buy order and reversed, and you didn't get filled? That's very possible. The problem when you're doing it with a broker over the phone is that order goes into the pit. It goes to an executing broker in the pit itself. So you've got a runner, and the order got to go back to the runner, back to the phone bank, back to the broker, and the broker calls you with a fill. You're talking several minutes. Now, what if you're in a situation in a fast market where the market actually hit your price? You may have gotten filled, but you really don't know. You don't want to put a stop in the market because you don't even know if you're in or not. And the market's screaming, let's say, even in your favor, and you'd like to take profits, but you still haven't gotten your fill back yet. You don't even know if you're in the market. This is the kind of stuff we had to deal with all the time. All the time. It was a completely different world. Not only that, the only information that we had available to us was open, high, low, and close. That was it. Open, high, low, and close bars. And we used to have to get those unless we talked to our broker and pestered them, X number of times a day. You get it through the Wall Street Journal. We used to have to keep our own daily charts. Intraday stuff was just like non-existent. So anyway, I started trading like that. I went through. I don't even remember what my first trading account was. I think it was around $20,000. I lost all of that, and then, saved up some money and opened up another one for around 15, lost all of that, and then went to another broker, and I'm thinking this guy doesn't know what he's doing, and I'll find somebody who does. And then this is what really, this is probably the reason I'm even standing here today, was this particular trade, because this particular trade, it had a profound impact on me in terms of how it changed my life and what I was willing to do to find out what this was all about. To find out really what does it take to be a consistently successful trader? What does it take to really be able to earn an income as a trader? I was long silver. This would have been back in right around 1980 or 1981, or 1980, I think. I was long silver at around $9.75 an ounce. And there's two 5,000 ounce contracts at the COMEX. In other words, I was long 10,000 ounces of silver at $9.75 an ounce. And right after I got into the market dropped about 20 cents on me to about $9.55. So I was down $2,000. And my broker said, well, okay, here's what we're going to do. Instead of getting out, we'll put you into a spread. And so what we'll do is you're long 10,000 ounces of silver in New York. We'll go short 10,000 ounces of silver in Chicago, because you could trade Chicago silver at the Chicago Board of Trade. Everybody with me on this? Just want to make sure that you guys are all with, even though I know many of you are stock traders, the concept is the same, okay? So I'm long 10,000 at 9.75. He puts me short 10,000 at 9.55 in Chicago. So I've got this spread going on. And then he said, well, when the market goes back in your favor, we'll just take the short leg of the spread off. Now, keep in mind, back then, you guys are. What do you typically pay for commissions, even in commodities, or even I don't know what you'd pay for stocks, but typically the average commission is about $4 to $5 a round turn, right? That's what you'd expect to pay. No, what are you paying? Less?
No, more.
More? Round turn? Oh, really?
I got the lowest.
Well, you're in the Dow. You're in the Dow Mini. What are you paying for the Dow Mini?
11.
11.
Well, that's as low as it started at like 30.
Oh, okay. Well, anyway, then 11.
89 back in the day.
Oh, okay. Well, back then, back in the 80s, how much do you think we were paying back then? Come on, give me a guess. Come on. Guess. What? Yeah, 125. How's 125 a round turn per contract? So in other words, for me to put this trade on cost me $250. Okay? When he put this one on right here, it cost me another $250. And then he said, of course, that when the market goes back into my favor, he'll take the short leg of the spread off, and I should be all right. So that's exactly what the market did. The market went back up to, right around the 975 area. He took the short leg of the spread off, and then the market immediately dropped back down another 20 cents and put the short leg of the spread back on again. So that's another $250, okay? Plus, he just locked in, when he took this off, first of all, he locked in a $2,000 loss by putting this trade on. When the market went back up to 975 and he took this off, he locked in another $2,000 loss. And then when it went back down again, he put it back on and locked in another $2,000 loss. Now I'm down $6,750. Okay? And then, of course, it happened 2 or 3 more times. Now, from the market's perspective, the silver market's just in a trading range. That's all it is. It's just in a trading range. But I didn't know how to read chart patterns at the time and didn't really understand what was going on. I was just listening to him. And so what he was doing was just taking advantage of the fact that it's going back and forth between support and resistance and generating commissions for himself, okay? That was it. That's basically he was just turning my account. But that's not the story, okay? That's happened to a lot of people. Of course, it happens less now because we're all responsible for the trades that we put on. All we have to do is click the mouse button, and it's not that much money. But here's the story: is that as these losses are mounting, okay, and I can't sleep and getting real stressed out. I wake up one morning and I thought, what, this is it. I just can't take this anymore. I just can't take it. And so, when I got to work, I called them and I said, you know what, just get out of the whole damn thing. I just can't do this. So just liquidate the position. Does anybody remember the Hunt Brothers silver debacle? Oh, It didn't. Does anybody? If I say the word limit up, does anybody understand what I mean by that? Okay. The exchanges will impose artificial price limits of how much a commodity, or even a stock for that matter, can fluctuate in any given day before they stop trading. So we don't have these kinds of moves too much anymore. But back in the 80s, limit moves were really quite common. They really were. In other words, what would happen is this: is that if the market went up, let's say, I think in silver it was 50 cents. I don't remember exactly what it was, but if the market went up by 50 cents, they would actually stop trading. Meaning, if the market was bid up to, let's say in this case, $10.25, trading would stop. In essence, what this means is that at 10:25 there were no people. There wasn't anybody in the world. There wasn't. This is important for later on. There wasn't one person in the world who was willing to sell silver at 10:25 if it was a limit move. Not one person. And so what happens is that the price will go up, seeking to find who will actually sell. So what the exchanges didn't want is there to be this huge fluctuation all in one day. There might have been sellers at 10.26, or there might have been sellers at $11, but you don't know that because the exchange says we're going to stop trading at 10.25. You guys with me on this? Okay. So what happened is that I don't think it happened more than maybe half an hour, 45 minutes after I got out. The market was trading right around $9.75 an ounce, where silver went limit up. And went limit up, was 30 days in a row to $49 an ounce. To $49 an ounce. I was looking now. Think about this. Okay, now think about being in this kind of a winning trade. Now, when we're in a winning trade, the market almost never goes straight up, and it never goes straight down. There are rare occasions, of course, like in this case, when it does. So that when we're in a winning trade, we have to constantly be making decisions about where we're going to take profits and how much heat we can take with the market coming back against our position to say, well, is this a time to take profits? Or am I going to let it come back a little bit further? Am I going to come back a little bit further against me? Because, well, is this a normal retracement or is this more significant, okay? Is this a little bit of a profit-taking retracement? Is it more significant? Should I get out now? Do we have more left? Are we going to make new highs? You got to be making all these kinds of decisions. And it's very difficult, as we all know, right? See, in this case, I didn't have to be making any decisions because the market went limit up 30 days in a row. Boom, boom. It was like, go ahead. I was out. I just got out like a half an hour before it happened.
So you were just going, oh my God.
Oh, yeah. See, the problem is I couldn't even get back in because there wasn't anybody willing to take the other side of the buy orders. On a limit move, you can't get back in. So I sat back and watched in complete agony. I mean intense agony. I didn't throw up, but it's like maybe I almost did. I don't know. Go ahead.
Why didn't you get out? You said you had 5 contracts?
No, 2.
Why don't you just take one off the table, let the other one run for another day?
First of all, Jerry, you're assuming that I knew that this was going to happen.
No, I'm assuming that getting out all at once takes you out of the play completely.
Jerry, have you ever been in a situation where you really lost a ton of money and you just can't deal with it anymore?
Yeah.
I've
been in a situation where I've been down a lot of money. Okay. I didn't lose because that's on paper.
No, well, commodities, no. With stocks, you're right. With stocks, it's technically on paper. When you're in commodities, the money's out of your account. It's gone. It's gone at the end of the day. Okay? It's not. This is not paper money. This is real money. Are you with me on this?
Yeah, I'm understanding you.
Okay. So I wasn't looking at like I said, paper losses. The money was out of my account. So I had enough. I couldn't take it anymore. So when you think about it in that context, when you just made up your mind that I just can't deal with this anymore, it doesn't even occur to you to get out in stages. Why would I get out in stages when I've already gone through a week and a half of this back and forth and and it's virtually wiped out my account? Because by then I probably would have had to put more money, even for me to take just one contract off and leave one on, I probably would have had to put more money in the account. And there just wasn't any point in doing that. Are you with me on this?
I don't trade commodities. I trade other things,
But the concept's the same.
except it doesn't come out of my. It's, as you said, it's a paper trade.
Yeah, you already own. If you own stock, you own an asset.
I don't know.
And if you want to hold on to that asset until it goes down to zero, that's fine. Okay, your money is not flowing. In a sense, money's flowing out of your account, but not in the same way it is with a commodity.
No. Yeah.
Okay, I have to pay that money right now. You're just losing the value of an asset. I actually have to pay that money, and it comes out every single day. Go ahead. Go ahead and hand the microphone back to that gentleman.
Well, another thing that can be of interest here is, at least from the way I gathered you was talking a while ago, you really weren't controlling this. Your broker was doing this.
Correct.
So even if you had wanted to get out in stages, your broker was doing it, saying, hey, here's what I'm doing to you in this case.
Yeah, pretty much. Yeah, it's like I wasn't really in control of the situation because I didn't know what I was doing. All I know is that I was within, let's say, a half an hour, 45 minutes of a monster trade. A monster trade. Yeah. And like I said, I sat back and watched in agony as the market went up to $49 an ounce. I'm thinking to myself, I was like that close to $400,000 on just 2 contracts. $400,000. And so, like I said, when I first started telling you this really had a profound impact on me. It really did. And I thought to myself, and at the time, I was managing a commercial casualty insurance agency in the suburbs of Detroit. Not really, I thought that's what I wanted to do. I didn't really know what I wanted to do, but, I aspired to management. I was very successful. And, at the time, even back then in the late 70s, early 80s, was making a 6-figure income, and I was only in my early 30s. So, I really had a lot of things going for me. But, after this experience, I thought to myself, I got to figure out what's going on here. And I certainly wasn't going to be able to do it in Michigan. So I thought, what? I'm going to Chicago. And that's what I did. I went to Chicago. I just thought, if I'm going to get into the business, who am I going to get into the business with? Well, back then there was Merrill Lynch, there's Dean Witter, Smith Barney, and I thought, who are you going to pick? You pick Merrill Lynch, right? Okay, so I went over to the Chicago Board of Trade. They have an office right there, and right on the second floor of the Chicago Board of Trade. And they just so happened they had 3 openings for trainee brokers, and they had over 1,000 people applying for it. So how am I gonna be one of those 3 people? I thought, well, you know what? I went back home. I went to one of the bigger Merrill Lynch offices in the Detroit area, and I went through the whole employment process to familiarize myself with what it is that they required to get a job. And this is what I think got me that job at the Board of Trade, is that they had an aptitude test, and there's a multi-page application, but on the back of the application they had a square like this, and they wanted spontaneously, while you're filling this application out, spontaneously what they wanted you to do was to write like a little mini essay about some philosophical question. Before I went to the Board of Trade and actually filled out that application, I spent 2 weeks agonizing over every word, just to make sure every word of that 2 or 3 paragraphs that I wrote down was completely perfect. So that when I took the app, I wrote down exactly what I'd worked on. And I can imagine why they hired me, because if you thought that I wrote that spontaneously in the moment, but hey, this guy, we got to have this guy here. We got to have this guy. Okay, so I did. I got the job. Now think about this. Now, when I was working for the agency, the casualty agency, commercial casualty insurance, as a matter of fact, I just signed a contract not more than like 3 or 4 months before I actually went to work in Chicago, over a 3-year period for $360,000. And what Merrill Lynch was offering me was $20,000 on a draw. Okay, in other words, it was they're going to give me $20,000, but it's a draw. I mean, I got to pay it back based on commissions. Now, if you can imagine, there wasn't one person in my life, not one person, who thought that I wasn't absolutely stark raving out of my mind to give that up, to go to Chicago to do this. So, it wasn't like I had a lot of support. You know, and I wasn't like I wasn't catching a lot of grief from everybody that I knew about what it was that I was doing. So you can imagine my horror, is a good word for it. I mean, because when I got to Chicago, I'm thinking, why am I even doing this? I'm doing this because I'm going to Chicago because that's where the traders are. That's where the people are who know what they're doing. Correct? And then to get there to find out that is not the case. That is not the case at all. That there were 40, almost 50 brokers in the office, and none of them knew how to trade. And not only did they not know how to trade, I mean, Merrill Lynch made absolutely no bones about the fact that we were not traders. They spent no money, no time, and completely discouraged us from even learning how to trade. We were salesmen. We were taught how to talk about trading. We were taught how to talk about investments. We were taught how to, it's called dialing for dollars, to get on the phone and get people to open up accounts. And even though this was unspoken, I'd say the underlying philosophy behind the business was, especially in the commodities business, I'm not talking about the equities. I'm not saying that on the equity side of the business that it wasn't more reputable, but this was about as irreputable as it could be, because the underlying philosophy that we operated from was all commodity traders are terminal, meaning like they have a terminal illness. It's only a matter of time before they, when I say all commodity traders are terminal, and it is our job as a broker to make them as comfortable as possible until they expire.
All right, now I'm going to stop it there. That has been a conclusion of the Stock Trading Psychology Seminar, Part 1 of 4, Think Like a Professional Trader by Mark Douglas. Okay, this is the guy who gave me my footing, all right, one of the people that played a part of my journey to get me to thinking correctly and to get me in gear with what it took to be a more consistent trader, all right? I thank you guys for watching. If you enjoyed this episode and you want more things like this, then just hit the like button and let me know below if you enjoyed the episode, all right? Thank you guys for watching. Have a blessed day out there, all right? Enjoy these summer vibes, all right? Stick to your family close. Study, all right? Have some peace, productive weekend. Until the next time, peace.